Welcome to Berman's Call today on BNN Bloomberg. I'm Marella Fernandez here with Larry Berman. Joining us now, we're here to take your questions on stocks and ETFs. So give us a call. Here's how to reach us. 1-855-326-6266. You can also send an email, bermanscall@bnnbloomberg.ca. Larry, thanks for coming in. We have to start today talking about tariffs. There seems to be no other topic around. And we know Donald Trump just affirmed tariffs will take effect tomorrow. The major markets have been flipping around mostly in the red today, but not a lot of crazy sell-off, it looks like. What's your take on how tariffs are going to play out in the markets tomorrow?
Yeah, crazy is a relative term. We could see by tomorrow, 10 a.m., that they're not going to start. Like it really depends. But I do believe Canada's got a lame duck government at the moment. We don't have a strong leader. And so what's the negotiating point? So Trump probably sees Canada as vulnerable, certainly more vulnerable than Mexico at this point. Canada is more of a friend to China than the U.S. would probably like to. So, yeah, he's going to choose to be a bully at this point, not unlike what he's trying to do with Russia and Ukraine. I mean, somewhat of an embarrassment that we saw on Friday with what went on in the White House. Brings tears to my eyes in a sense, because while I'm a fan in the sense that there's a lot of things that are broken and President Trump is trying to fix them, I'm not a fan of his style on how he goes about doing things. So I think we can expect a few more things to be broken before they get cleaned up here. And that just means more market volatility overall.
Let's talk about the scope of the tariffs compared to his first round. How do you see it being different in the second term?
Well, he's learned a lot. He signed off on the USMCA. So did he make a bad deal with himself last time? Should it be better? Those are kind of bigger questions to answer. What is he looking for this time? Or is he just trying to do a deal because that's in his DNA? So TBD, but I don't think until we get a new leader in Canada here and a bit of a mandate, maybe with a new government, that we see a solution. So the question is, when Parliament gets called back in later this month, is the government going to fall, right away? Is there going to be a confidence motion around, for example, the spring budget? Or are we going to wait until later in the year where it was expected to be a fall election? We probably need an election now in order to, get to the table with them. So that'll be very, very interesting in the coming weeks. But right now, Canada's on our heels.
Will the tariffs, looking stateside, drag down growth in the U.S.? We know it'll have an effect here. Will it drag down growth in the U.S.?
So mathematically, it will. We're already starting to see that. The Atlanta GDP now, for example, where you looked at the U.S. trade statistics that came in Friday, and some of the numbers that we saw today are now forecasting a negative Q1. Now, this is mathematical. I believe there was a huge amount of front running in terms of imports into the U.S. to get ahead of these tariffs. So I think there's a little bit of funny math here in terms, is the economy slowing? There's no doubt about tariffs are not bullish. The question is the mechanics and the numbers. So for right now, it's a headwind. And I've been saying this for a number of months now, that there's nothing bullish about this in the short run. It should mean more market volatility. But as of yet, we haven't broken any trading ranges. If you brought up a chart of the S&P 500 since the U.S. election, and I'm not sure if we can bring up a hot chart for the last 3 months, but you can see we're pretty much bouncing around in a trading range. And until that trading range breaks to the downside, taking out the lows that were made in early November before President Trump got elected, which is still another 3% lower from where we are now, or until we can make a higher high. A week and a half ago, the S&P made a higher high on an intraday basis and then failed miserably. So the market's grinding here, looking for what the future is going to hold. And right now, there seems to be more headwinds than not.
Talking about market volatility here in the near term because of the tariffs, I'm just wondering, what, a few months down the road you see happening in Canada as a result of tariffs?
Well, again, if you're a business leader and you're in the manufacturing space and your sales or a big part of your sales go to the U.S., you're very, very concerned about your business. Our supply chain's going to rebalance. Now, I don't know that there's going to be enough replacement capacity built in the U.S. in the next 6 months to stop Americans who need aluminum and other things from Canada, trees and things to replace that. And so I think it's temporary. I don't think it's a permanent hit, but it really depends on what the ultimate deal plays out to be. In the long run, Canada, U.S., and Mexico are close allies, and to think of it any other way is naive.
All right, we're going to take a quick break, but coming up next, we'll get to your phone calls and your emails for Larry Berman. Here's the number again, and there is time to call 1-855-326-6266. Questions on ETFs and large cap stocks today. We're back in a moment. Welcome back to Berman's Call. We're here with Larry Berman, and the phone lines are open, so you can give us a call if you have a question for him. We're going to start with an email from Gary. He says, my father and mother, they're 94 and 90 years old, have invested their savings into 100% in Canadian companies. I now would like to add some geographical and sector diversification. Please recommend some ETFs which will pay high dividends and provide a high degree of security to increase diversification with their portfolio. So first off, Larry, they're older, a lot older now. Is it worthwhile to do at this point?
Well, so that's a good question. And an email like this, you've got to really dig a lot more. It sounds like the child in this case, which if the parents are in their 90s, might be in their 60s or early 70s, is maybe thinking about the use of the money for them. And maybe the objective is changing a little bit. Hard to know tax implications. Listen, sounds like it's 100% equity portfolio. So right away, that's a big problem for someone at that age. But someone even that's in their late 60s or 70s shouldn't really be having a all equity portfolio. Listen, the answer is there really isn't a good way to get equity exposure without a lot of risk. I imagine during the bad periods over the years, GFC and COVID, portfolio like this would have seen major downside shocks. So when the writer asked about, international exposure, less risk, two things come to mind. One, Canadian dollar is really expensive right now in the sense that buying a foreign asset is not a great time to put money as a weak Canadian dollar into a foreign security. Two, there are some ETFs that provide international exposure with covered calls and things like that. And I would say for Europe, ZWE would be a currency hedged way to get exposure to international dividend payers. But a lot of that return is not going to get as favorable tax treatment as you are from a Canadian corporation. So I would really need to probe a lot deeper with this person that wrote the email in terms of really scoping out a financial plan. And I would strongly suggest that they sit down with a financial advisor and really scope out that after-tax return, because there's a lot more there that needs unpacking.
Got it. All right, let's go to another email. This one comes in from Evan. It says, I'm trying to learn more about the two BMO ETFs, ZTIP and TIPS. These would be for the fixed income portion of my non-registered account. They seem to have performed well over the last couple of years. Does Larry expect that trend to continue, or does he prefer other U.S. bond ETFs?
Yeah, so the problem with inflation and index bonds are when inflation is expected to go up, these can perform really well if inflation actually goes up, because you have this embedded higher payment based on the current rate of inflation. But if the market anticipates inflation rising and it doesn't, then these bonds perform horribly. And I think for the average investor, they should not touch them. These are very, very high-end securities that should be left to professionals. And I don't recommend at all that individuals try to play and use tips, because you really have to understand break evens. You have to understand the changes or the delta in inflation expectations, and then what's already priced into the market. And so I don't recommend these for individual investors at all.
Got it. All right, let's go to the phones because George has been holding on from Gander, Newfoundland. George, what's your question today for Larry?
Good afternoon. I think we're living in interesting times. I would like your opinion, Larry. I've never invested in Canadian green energy or any green energy, and I'm like to see if you want to recommend one or two ETFs for it for the long term, and if this or fairly soon might be a good time to buy in. And I thank you very kindly. All the best, folks.
Now, green energy has a big question mark at this point, right, with Donald Trump in power?
It does, and so it's an asset class that I've had exposure to, that I've suggested that people invest in. BMO has a ZCLN as an ETF, and if you look at that over the last few years, it's performed absolutely horrible because green energy in the first couple of years of the Biden administration really did well. And you had this massive rally, and then ever since has been done very poorly. And you can see it there. If you were to put it in a 5-year chart for a bit better perspective, that gives you the pre and post COVID and the whole Biden administration there. It doesn't quite go back that long here in the graphic. But there was a high point.
We've just pulled up the 5-year if you want to have a look at that too.
Yeah, no, so I see that there, and it's really not capturing that COVID. Maybe we would need a bit longer than that. Anyways, my point being, it is getting cheap. It's on my radar to add to. I need to see how Trump behaves in the next 6 to 12 months in terms of this sector, because he's very anti-green energy at the moment. So from that perspective, it's making it Warren Buffett-like cheap. But you always need a catalyst to get it going again. And I'm not sure what that's going to be at the moment under Donald Trump administration.
Yeah,
so it's on the radar, but it's not a hard recommendation to step in.
Catalyst might not come. Okay, let's leave it there. We'll go to another caller. Doug is on the line calling today from Montreal. Hi, Doug.
Hi. Yeah, hi, first-time caller. Actually, what I'm asking about is to formalize my emergency fund, with everything that's going on. And obviously the criteria, some liquidity or good liquidity, safety, and hopefully some reasonable rate of return. I was thinking that maybe a 50-50 hybrid strategy of, money markets / government bonds, and perhaps some corporate bonds, high-quality corporate bonds. What do you think?
I'm always a fan of high-quality corporate bonds in the sense that they're paying you better than government bonds. But right now, credit spreads are very tight. And so while you're getting paid a little bit more in a corporate bond, if you go into a hard economic landing, credit performs poorly generally, right? Credit spreads widen and corporate bonds tend to underperform, even very high quality ones. So that's a caveat. Money market is fine, but the Bank of Canada has been cutting rates, and they are going to continue likely to cut rates this year, especially if tariffs have a meaningful impact on the Canadian economy. And so you're going to get less and less of a safe yield. What I really like a lot is the private credit markets. Have a look at some residential mortgage funds. You tend to get monthly liquidity with them, but you're getting yields in the 6, 7, 8% range. And so you're getting paid pretty nicely. And if monthly liquidity can work for you, I really recommend those for safe money at this point. I know a couple of companies advertise here on BNN. I'm not speaking to any specific one. There are 300 mortgage funds like that in Canada. But some of the big ones that have hundreds of millions in them are probably going to be really safe investments for people looking for safe assets and a real type of return to their savings.
Got it. All right, that was for Doug. Let's move on now to Mary, who's calling us from Kingston, Ontario. Hi, Mary. What is your question today?
Oh, hi. Thanks for taking my call. And my question is about ZFH, the floating rate bond fund, BMO. I hold it and wonder, should I keep holding it? Thank you.
Yeah, so here, floating rate notes tend to do very, very well in general when yields are rising, because what BMO does with this, they use a bunch of derivatives inside to really try to extract the pure yield that's coming out of high yield. So this is a higher yield exposure. So you're getting a pretty decent total return in terms of the coupon. If you look at the price change over the last 5 years, there's been no price change at all, but you're earning about 5.5% right now. Again, I don't love that credit spreads are really tight here, and for the risk of high yield, it's not attractive to me at all. You can see that when credit spreads widened, when the central banks were raising rates in 2022, this fund did very, very poorly on a price perspective. And so again, if we go into a hard landing, even though it's floating rate, you're going to get credit spread widening, and this fund doesn't protect you from that part of it. And therefore, you have a little bit more risk than you think. I would say to this caller again, have a look at private mortgage companies and residential exposure. You've got a lot of protection, you've got a lot of diversification, and you get a way better yield than you're getting in a vehicle like this.
All right, let's try and squeeze in Chuck before the break. Chuck's calling today from Calgary. Chuck, what's your question?
Oh, good afternoon. I'd like to ask Larry about Northland Power, NPI. I bought it last year at just under $22 and went up a little bit. And it's been coming down since, hit the ditch here in early February, and it's recovering now. And I'd like to know what I can expect from this, and what do you think an actual 25% tariff could do to this stock? I'll hang up and listen. Thank you.
Thank you.
Yeah, no, I'm not sure if they're going to put a tariff on energy power that's transferring over the border or not. I haven't looked at it in that detail, but this has been hit along with a lot of the other clean energy plays over the last couple of years, where they do a lot of generation in terms of solar and things like that. So I like it here. It's a name we're nibbling at on weakness. I think there's a compelling yield to it at this point. But I don't see a whole lot of upside. I would say it would be capped in the mid-20s for the next 3 to 5 years.
Got it. Okay, Larry, we are going to take a quick break. Coming up, today's educational segment. We're back in a moment.
Berman is one of Canada's top technical analysts. He's the Chief Investment Officer of ETF Capital Management. To learn more, visit etfcm.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN, its parent company, or affiliates.
Welcome back to Berman's Call. We're here with Larry Berman, and time now for Larry's educational segment. Larry, take it away.
Yeah, so I pay attention to what's happening in the options market a lot, and we use options a lot at QL for hedging and different things. And since they've gone to the 0 day to expiry options for the main indexes, it's caused and added a lot of volatility, to markets. So I wanted to spend today's educational segment just talking about some of the influences. Late Friday, I'm involved in this chat room on the Bloomberg terminal, and they posted late in the trading day what the risk was for the day's options. And it showed there was a massive amount of open interest at 5,900, 5,910, 5,920. And I think we have a board showing these. But here's the graphic. And so as the market was breaking to new highs with about an hour left in the day, and you can see that at 3 o'clock there. Initially, the market makers were kind of defending that level. And then a series of headlines actually hit right around that time from Treasury Secretary Besant. And if you can put up the call strikes, and you can see, because when you think about hedging a call position. What you're doing here, the minute before the call expires, the odds of it being in the money or out of the money is a coin flip. And so as it goes more and more in the money, it forces the market maker to buy more and more. So the marketplace knows this, and it can force buying and selling in the market as it runs through these technical levels. And so this was a big thing late Friday, and we saw that massive spike up there in the chart in the last 45 minutes of trading, which completely has been wiped out. In fact, most of Friday's rally has been completely wiped out. And as we sit here now, we're actually making lower lows on the day. So if we were to extend this chart down, it would be all the way back down below those lows that we saw at midday on Friday, and running stops on options in the opposite direction. So again, these zero data option expiries are really adding a lot of volatility to markets. If you look at the trends here, what you can see is as a percentage of the daily option volume, you can see January and February, as political uncertainty has grown, as the rhetoric of the White House has grown, tariff risks, more and more use of these options, but a significant portion of the options are being written from 0 to 1 week. So you can see the 0-day options, 56% in February, the 1 to 7 day, the 1 week options, another 21%. So the vast majority of optionality is being written very, very short term, which leads to these gamma trades, which leads to more volatility and more speculation. And I think investors need to get used to this really as a dynamic in markets. And it's going to be very, very whippy. Even for people who are technical traders out there and use technical analysis, you got to pay attention to the options market here, because it's really an added dynamic that 2 or 3 years ago we didn't have, and it's going to be more and more so, especially with the geopolitical uncertainty around.
You're asking people to pay attention, but quickly, I mean, how do they manage the uncertainty around a Donald Trump presidency? Very quickly.
Well, very quickly, you don't want to change your portfolio in the day-to-day of the unknown of what comes out of the White House. You should have a portfolio set for your longer-term strategic goals and actually not pay attention to the noise. I know it's hard, but that is the right advice. For those day traders out there, completely different story. They're watching the markets all the time, and this is a tool for them to help.
Got it. All right, Larry Berman, sir, thanks for joining us. If you want to get in touch with Larry, you can do that YouTube all the way to LinkedIn. And that's it for today's show. Join us for Berman's Call Mondays, 3 p.m. Eastern, 12 to noon Pacific. Thanks for joining us.